trades, get stuff going, by and large, an inside day in most asset classes, but some stuff moving. And yields, Pete, are the new stocks. Did you hear about this? And this stuff goes in and out of fashion. Like, for instance, before I was born, or as I was getting born in the early 90s, weren't like trading bonds.
How do you get born? That's a discussion for another day.
Well, when a man loves a woman, there tends to be
when I'm getting born.
I guess I was conceived
when your mother's giving birth, not getting born.
Summertime 1992, my mom and dad got very close. And then March 1993, I showed up. But back then, bonds were kind of more sexy of a trade than stocks. Last 20, 25 years, stocks
Agreed.
A lot sexier of a trade than bonds. Are
you saying that 21 basis points is not sexy?
Well, yields, Pete, in the last week, I will say, have become more attractive in my mind and a lot of traders. We've seen the volumes from the small exchange jump up significantly in the yield products as stocks we saw some volatility in stocks last week, but really circling highs. Yields in the last year and a half have gone from being, 1%, 2%, 3% to being cut by, down to 10 basis points, 50 basis points in some scenarios. And now they've doubled in the last couple of weeks and are seeing a ton of volatility around this new range. I mean, you and I are not hard to persuade of this fact, but wouldn't you say that yields have become just a better day trade, a better futures trade in general than stock equity index futures at this point?
Yes, especially at this point. Absolutely. There seems to be still, even at these depressed levels, a little bit more uncertainty than there is the certainty of that stocks inevitably will be trading higher as we see SPOOs put in contract highs. So yes, at this moment, I think that is a very good way to look at things.
Yeah, absolutely. And what we looked at in general here in this week's newsletter, the article that went out to people, if you haven't already taken a look at the small exchange community, go to subscribers.thesmalexchange.com. You get exclusively low fees, exclusive content, and access to a bunch of merch giveaways, of which we're about to kick off a new one. We're about to give away our oil shorts from last month, and then also kick into gear something around our cannabis product, which is going to be very cool merch going out to exclusively the people in our community. Go check it out, subscribers.thesmalexchange.com. But in that newsletter, Pete, I talked about adding yields to your stock trades, right, and how that simple addition of one market to a singular market increases your paths to profits. Because if I look at stocks, Pete, and I just say, hey, they're expensive, I think that they're going to go down in the next day, the next week, the next month, what have you, and I sell them, the only way that I make money is if stocks go down. But if I sell stocks that are at a historical high and buy yields that are at near a historical low, they're both highly correlated. I now have three paths to profits because I can make money if stocks move lower and yields move higher. If I'm, long yields and short stocks. So if stocks move lower, yields move higher, then I can make money that way. If they both move lower, but stocks move lower than yields, then I make money that way. If they both move higher, but yields move higher than stocks, then you make money that way. And simply, you're not necessarily, Pete, jumping from a probability of profit from 50% to 70 or 80%, but you're increasing the amount of ways that you can make money in the near term.
Right, absolutely. And I think anything you could do, because you look at this 21 basis point 2-year, or even where are we now in the tens? We're back under 140 basis points.
Yeah, like 130, 140.
Right. I think that anything that could give me time in a trade, especially if I'm looking at a little bit more strategic pairs trade, is a really good thing to do right now. Because I think we would have argued that equities, we had no idea where they may stop. We thought they might stop before this, but we weren't drawing lines in the sand. I think to the same extent, we knew that we feel yields will quote unquote normalize. But if you had asked us, I think January 1st, we would have said by June, we would have been back to a 2.5 or 3% 10-year. You see where we are right now. So time in a single trade is challenging when you're waiting for some of these bigger events to transpire. Pairs trades like this that give you both sets of extremes give you time, which I think is really important.
Absolutely. And I want to speak a little bit about US dollars and yields because they've become, and this is a very short-term trend, but in the last
different
couple
type of
weeks,
trade, right? Absolutely.
In the last couple of weeks here, this has become a very opportunistic market in terms of all of the movement here. You've got a US dollar market that in the last couple of months has been down 2 or 3%, has bounced back huge in the last couple of days here. We've seen that US dollar market just move in both directions in the short term. And then also you've got yields doing a similar thing, but in the opposing direction. You saw the big up move in 2 years and then them give back a lot of that. You move across the curve, you have a very different story. You've got a 10-year and a 30-year that on a percentage basis are down 20, 15%, in the same time that 2-year yields are higher and the US dollar is rallying. So a mixed bag here. Usually you tend to see all parts of the yield curve move higher by different degrees or lower by different degrees. You've got that front part of the yield curve outperforming the rest of the yield curve. But this is all to say that these four markets, US dollars, 2 years, 10 years, and 30 years, have been some of the most volatile when you look at pretty much a flat stock market over the last few months.
Yeah, absolutely. And I think that uncertainty piece, too, gives you the back and forth. I'm so glad you put the percentages in here because it's interesting. And you wrap the percentages with the caveat because the 2-year is just so low, so close to zero. Remember, a couple of tenths of a basis points can move it by 1%. But let's just take that off. We all accept that. But look at the back and forth. And part of the shape of this, I'm so glad you put all three on there, is I don't know, abnormal may be too strong a term, whatever, but it's abnormal for us as traders, Frankie. We don't expect to see that. That puts us on guard a little bit. So it adds a little bit of uncertainty. And that is what we look for as uncertainty. Uncertainty gives us back and forth. Certainty doesn't give us anything. Certainty stinks as a trader.
Yeah.
And right now, the certainty is that equities are going to trade higher forever. Now, that certainty it lasts until it doesn't. But right now, you want markets with uncertain outcomes that are more prevalent, and that gives you this back and forth that you're talking about. So it's a great space to focus on.
You're exactly. I'm glad that you used that uncertain word because that is synonymous with opportunity. Like you say, if there's a certainty to a market, for instance, until the last month or so, the certainty that the Fed is going to keep short-term rates at zero, there's nothing to trade there.
Right.
Or like you say, the certainty of, stocks will just continue higher and higher and higher. And that certainty will get called into question at some point. And that's when you see, a correction or a crash or what have you. But uncertainty right now is in US dollars and yields. That is where you're seeing that uncertainty, and it's playing out in big moves in both directions. And that's why we advocate, especially for that US dollar, just getting on the other side of some of these big moves. Or if you're long yields and you saw this big move higher, getting rid of some of that long exposure and then trying to catch some more as it trends lower again. Because rarely, even if 2-year rates, Pete, do take off from their lows of 15 basis points up to a more normal 1% or 100 basis points, even if they do make that trip in the next few months, Pete, it's rarely a straight shot. We're going to see what we just saw, which was 15 basis points up to 25, back down to 20, up to 30, back down to 25. Like the back and forth, the uncertainty, whatever you want to call it, is so largely focused in US dollars and US yields. And I hate to see people missing out on it, waiting for a big move in stocks. Now, that being said, we are finally getting, at least last week, we'll see if it continues this week a little bit, a tradable range in these equities, which is just to say that we saw last week two sides of the range. Now, did stocks cough up all of the gains from the last few months or the last few years? Absolutely not. They're still holding on to some of those equity index futures, making new highs. But Pete, this is one of the first weeks where I feel like I can be confident in selling the upside of the range in SM75 and sticks and maybe seeing them come back and meet the other side of the range, because that's what we saw last week.
Right. Sorry.
No, you're good. You got the dogs barking over there on your side, so I can spiel a little bit longer. But it's just a matter of, I don't think we're seeing the uncertainty like we are in those yield and dollar products, and thus I wouldn't expect like a 5 or 10% drop in the stock market. But last week showed us that you can expect a 1 or 2% drop and trade like what we have here, which is a very realistic realized volatility based projected range for SM75 and sticks. And you saw a little bit of the upside of that range this morning with SM75.
I think you make a great point in terms of the tradable range and the expectation around that.
Yeah.
And I love the idea that, you know what, you're looking for that 1%, that 1.5%, which we've gotten back and forth. Relentlessly seeming to always end up to the upside, but we've gotten that. And, when we look for that in the period of tradable opportunity, this speaks to expectations. Now, at some point, and I'm interested to see for you, we know these change. The expectations around whether it should be 1% or 3%. We've seen it be both over the last year. At what point, though, does that percent get so small that you are maybe not, it has to get really small for me not to trade things.
Sure.
But the amount of the occurrences, at what point do you get to a point where the amount of occurrences materially shrink for you? In other words, if we got down to where we're moving and we've been spending a lot of time between 1% and 2.5%, we got down to 0.5%, 0.6. What would your strategy? We know our expectations change because the market's only giving you X, but does that really then, that narrowness of that move, that lack of elasticity, does that take you out of the game?
I think it theoretically does at some point, but thankfully that theoretical value is the unseen value in VIX and some of these volatility.
Right.
Like whenever we get down here to low volatility, and granted, that low volatility is still translating on this week's basis worth of $3.50 in range in SM75, which is, well over a few percentage points. Same thing for sticks, about $2.50 worth of range in there, a few percentage points. So I think that's still viable in these products. But yeah, people do, when volatility gets to the lows, people do like to make this case of like, oh, well, stocks are going to get so safe and so fearless that there's going to be no trading range. We never get there. Like there's never been I don't think there's ever been a point in your or my trading career where stocks have been just completely untradeable. When they get low vol, people say like, oh, the next thing is they'll be untradeable and they'll have 0% move, but we're not there yet.
No, you lose tools. But here, and really the kicker on what I was really going to finish with here is that when we get to that point, maybe we have fewer occurrences because some strategies have been removed from us. But this is the beauty of a diversified market. We move on to what we just talked about. We move back into the world of things we like. Oh, I love this. My favorite part of the week.
Yeah, this is quickly becoming everybody's favorite segment. Pete is going to now rank the pairs of the week, Pete. All right, so you're going to do first, second, and third. We've got 3 beautiful pairs trades for you. First one being long pot stocks, short tech stocks. And now there is a pretty decent correlation there between the two. As you can see, pot stocks peaked in the early part of, I believe it was maybe this year, maybe last year, but it's been mostly downside for pot stocks, seeing actually new lows in the S420 index just last week. Is it time for you to buy pot stocks and sell the tech stocks that haven't seen nearly as much downside? Don't say yet.
I'm not. I know.
Next one has been one that has seen lower values, but finally seeing a little bit of upside in this spread. And it's one that you've liked in the past. The NAV spread, long 30 years, short 10 years, 1-to-1 basis, looking at the steepener there, being long S30Y, short S10Y. Saw the lows in this spread, like I say, a couple weeks ago. Finally getting to see a little bit of upside in that steepener trade. We'll see what comes in the future. And then last one, but not least, looking at hedging metals with US dollar. This one I could go either way on in terms of the direction, just because metals are kind of at a midpoint for me right now. But you'd be looking at a long metals, long US dollar, or short metals, short US dollar. Rank them 1, 2, 3, go.
Short metals, short US dollar, number one. Number two is the knob spread, but I'll put the caveat behind that. I'll go back to, and then the S420 pot stocks versus tech stocks. I get the extreme. I just don't see the trade there for me right now. In my mind, I'm not getting enough protection on the pot stocks. I'd really have to look at how many S420s I'd want to add to feel I'm getting some reflexivity of my short sticks. I feel like I've got a short sticks position, which you obviously do with that pair, but I don't know how much the Band-Aid is. And that's just a little bit of a new product. So I have to, use that a little bit more to get a sense out of that. But I love the spree SFX. Metals have been quiet. They don't stay quiet forever. We are in a range, but at the upper end of that range. I love that. I love that trade right there. I love shorting metals, shorting the dollar right here. I think that is an awfully nice trade with the dollar back up to 146. We're accepting that range of 143 to 147. We're there. The knob spread, my caveat is this has been my go-to trade. And you're right. We've stopped collapsing this week. We got down to 54 basis points, which was a multi-year low. And what that means is that's the difference between the yield on the 30-year note and the 30-year bond and the 10-year note. Here's the rub. This is what kind of holds me back. And I think you know the answer to this question. You know the first part. What's the yield of German 10-year debt? Again, another developed nation.
Well,
we're at 130
negative,
basis. Yeah. How much?
Negative. Negative, right?
Right. But how many basis points? Just curious.
I think you quizzed me last week. I think it's like what, 40 or 50 basis points?
That's exactly right. Their 2-year. What do you think their 2-year is? Shorter duration.
100 negative?
No, but it's negative 62. You're absolutely right. So that whole curve is inverted negative, which is the funkiest thing I've ever seen in my life. So does that mean our yield curve can't steepen? No, but remember, the world of traders uses global rates of different nations to hedge one another. So why hasn't this yield curve steepened? And this is a little bit of the battle that goes on. I love this knob spread. I love the fact that it's easy to put on with small 10s and small 30s because I know exactly what it is. And it definitely would be something that I'd want to inventory, but I got to go number one with spree SFX.
Okay, interesting. Yeah, and good caveat. I mean, inversion is always possible, but we spend like less than 1% of historical days inverted in the yield curve. Right. I'd rather be on the side of we're going to get more steep than flat.
Absolutely.
And so, yeah,
I think you're 100% right. And you know what? The last thing in my mind, and whatever the chuckleheads do, I don't think the 12 Fed chuckleheads want U.S. rates anywhere near zero. They're doing everything they can mechanically on the short end in the banking world to prevent this. They don't want anything to do with that. So it's not like these rates are going to go, in my mind, go to zero or go inverted, which speaks to probabilities of where we want to get the extreme. But it's a little bit of a patience trade for me.
Awesome. Cool. All right. We got some pairs trades going. We're going to get some more trades going in the next segment. Splash into futures. Thanks so much for watching, everybody. Peace.